Joining us right now is GFI Group Chief Macro Strategist John Spallanzani. John, good to see you.
Good seeing you.
What's going on in markets right now? Is money coming back into technology after the Amazon announcement of Whole Foods?
I think we saw some rotation out of tech and into some of the big financial names. Hopefully they're expecting some tax relief. Obviously a steeper yield curve because the Fed hiked rates. I think that we see small caps catching a bid again. Those had been flat for a while, for 6 months. We've been consolidating, so all the stocks that ran up after the election kind of went sideways, and now we're starting to see some rotation, which is healthy in the market. You know, the Nasdaq is up 16%. The S&P is almost up 10% now. And we saw a lot of momentum into, again, the diamonds. So there was a big divergence between tech last week. It was down like 150 basis points, but yet the diamonds were up 180 basis points. So that was a 3% swing in 1 week where guys obviously rotating out of tech and into some of the bigger names.
And the bigger names, when you say diamonds, bigger names being?
The Dow stocks and also the S&P stocks. People are expecting the effective tax rates on corporations to go down, so those corporations with the highest effective tax rates right now are being targeted because they're going to get the biggest boost if we do get some tax
targeted to buy. So so Wall Street still believes in tax reform in 17, is what you're saying?
I think that the media is more interested in 17 than 18. I think right now we're just worried about the message, but the message is good right now, and I think that whether it's 17 or 18, you know, there's other good things. You know, earnings are obviously very good. I don't think this rally is not based on multiple expansion. It's really based on earnings so far. So, you know, if you look at stock multiples compared to credit and bonds, stocks are still cheap relative to the other two. So where else are you going to put your money?
Okay, but they are still expensive relative to their earnings historically. So
that's a hard metric to pin down because
let's say they're not cheap relative to their earnings.
They're on the upper level of historic.
Here's what I'm wondering is how much of this is companies doing well, how much is the optimism surrounding Trump and reform, and how much is still very loose monetary policy around the world. We're in the U.S. kind of taking baby steps toward going back to normal, but the central banks have printed a lot of money.
Last week, even though we raised, a lot of people aren't pointing out that the central banks around the world, including Europe and Japan, are still easing at a rate of $1 trillion. So global central banks are still easing, although we're increasing rates in the U.S.
Yeah, there's still a lot of capital around. I think that's the other reason why our yield curve is so flat because, you know, again, treasuries are, you know, tier 1 capital that everybody has to have on their balance sheet. There's no alternative to treasuries, really. So, you know, do you want to invest in bonds at 27 basis points, which they were last night, or do you want to buy treasuries at, you know, 220? That's the trade. So there's not a lot of alternatives to what you have going on. So that's another thing that's keeping rates down that's helping us. Just last night, just this morning, you know, Carney said, listen, I'm not going to tighten. The Bank of England's not going to tighten because he fears we still have Brexit talks. We're going to go slow. Evans last night again, he said that, listen, we're not going to tighten. We might not tighten in September, maybe December, because inflation is still undershooting the Fed's target.
So the Fed is still a major factor here, is what you're saying, and easy money around the world. Let me ask you, what would you do right now? Do you want to put money into this market here, knowing that maybe the health care reform gets done next week? I mean, the health care bill, rather, the vote, and then tax reform later on in the year, and then what about Europe?
I think it's steady as she goes. I mean, I've been in bull for quite a long time. I still think that, you know, we're at 2,500 now. I have a few bets, personal bets, that we might hit 2,700 by the end of the year.
On the S&P 500?
On the S&P 500, yeah.
Right now, yeah.
It's a big move from here, but it's still June, and there's so much more left that we could do, and especially if the Fed does not hike in September, there's not a lot of resistance above. I think right now, what I'm watching is the unemployment rate in July, right? If we start to see that tick higher, then I would get more concerned. Right now, unemployment is obviously very low, and also, you know, wages are kind of not so hot.
No, stagnant.
I had a quick question on Brexit. We had 1 year anniversary a couple of days ago. They're starting to enter the negotiations. How do you see European stocks rolling as that negotiation starts?
European stocks have been actually performing better than our market right now. So
with the easy money there,
Yeah, the easy money. But I think that, you know, May has got problems, right? So we see that the more problems May has, the higher the market goes in Europe, right? So that's meaning that Brexit is not going to be a hard Brexit. So I think the market's kind of discounting that.
All right, we'll leave it there. Oil prices down again.
Who would have thought that oil would be at 44 and the stocks would be at 2,500? So oil is a technology-driven story, not a supply story, and not a recessionary story. That's a huge positive, oil being at 44.
Okay. A technology story?
Fracking and the ability for the U.S. to be one of the biggest exporters in the world, and that's really Trump's Trump card.
Great to see you. Thank you so much. John Spallanzani joining us there.